Hi, I'm Tracy Sofra and welcome to the Women of Wealth podcast. Let me share with you 3 really bad investing habits to avoid. So you might be interested in knowing what they are. Well, there's probably a lot of them, but the 3 main ones that stand out for me over the years of advising clients and what I have seen, I just want to share them with you today. Let me just start by saying your investment habits, and these 3 bad habits I've seen significantly, but they influence your portfolio without a doubt, right? And the chances of achieving financial success is really, really impacted by mainly these 3 worst investment habits that I can share with you today. So let me share the first one. What is it? Checking your portfolio daily. Stop doing that. So how can I say that in a nicer way? If you're when you're investing, we're talking long term. What's long term? 7 to 10 years. It doesn't matter what it does on a daily basis. What that does is you're going to find yourself, or if you're finding yourself checking your portfolio multiple times a day, that's really not good for your investment, because you're probably going to do something you regret, but mainly for your own mental health. If you're invested, you're definitely going to be invested in the share market. And as you know, the share market goes up and down all the time. So looking at that on a daily basis and judging it by it going up and down every day is not the long-term outlook that we talk about and the foundational knowledge about investing. While it may appear that that is a responsible thing to do, and, when I talk about being focused about your investments, I'm not talking about checking it on a daily basis. Frequently checking your portfolio can provoke this knee-jerking buying or selling decisions, and this is not what we want. We want to buy and hold for the long term and allow that investment to do what it needs to do. So you've got to have a certain level of restraint. You've got to have a certain level of managing your emotions. And who would have thought that that would be the thing when you're investing in shares, to be able to manage emotions when you're investing in shares? But nothing, I can't emphasize that enough and how important that is. A more patient, a long-term approach is what we're talking about. Do not be rattled by the ups and downs. It does happen. I don't check my portfolio on a daily basis. It is really irrelevant to me what happens on a daily basis, because the investment strategy that I have in place is for the long term. The investments I have selected are tried and true investments. I don't reinvent the wheel. I pretty much stick to what we call vanilla strategies, and I know that it's going to deliver what I want over the long term. So I don't check it daily, but I do make sure that I'm checking my portfolios either on a quarterly or 6-monthly basis and go from there. Obviously, having the strategy of adding to that portfolio, that's a set and forget. But again, checking that everything is aligned with where you want to go on a quarterly, 6-monthly, annually, 12-monthly basis. So regular but less frequent portfolio reviews is what I'm actually talking about here. What it does is it encourages investors to consider broader market trends, market meaning the share market, and making better informed decisions, looking at things in context rather than focusing on the ups and downs of every day, and then being having that knee-jerk reaction to, I'm going to sell it because it's gone down. It's done that for the last 3 days. But if you have a look at it in the long-term context, that's probably a little blimp. And I will say this, if you look at an investment portfolio, and if you look at it over, do me a favor, go on the ASX, Google the ASX, pick a share, just say CBA share price, and there will be a section there where you can actually look at it in the last week, in the last day, in the last 6 months, in the last 12 months, even in the last 5 to 10 years. And you will see how it's volatile over the short term, but over the long term, you will see that each one of those volatile moments are those little squiggly, it's not a straight line, it's a squiggly line, but if you look at the trend of the line, it always is going up. and every single little squiggly bit is an up and down that you would have experienced. So had you have pulled out, you would have come out at that point, and the trend of that graph being north facing, you would have missed out on all the future growth that happened within that share. So that is really important to understand. And when you can visually see that, it will make a lot more sense to you. So the best approach is actually counterintuitively to do nothing at all and to let it do its thing, trust in the process. But in order to trust in the process, you have to have made sure that you've invested in good quality blue chip portfolio of shares, whether it's direct or ETFs or managed funds. Sticking to tried and true is always my personal strategy. So avoid checking your portfolio every day or even every week or every month. Yeah. Longer intervals between checking tends to provide you with better returns simply because you're not going to respond to short-term market volatility. And as I always say, that is the nature of the beast. If you can't handle that, you're probably better off not investing in that, even though it's an amazing asset class that's going to give you growth over the long term. But you've got to be able to tolerate the ups and downs of being invested in shares. The second one that is a bad investment habit that you want to avoid is buying shares based on their popularity. Now, I see and hear this a lot as well. So Afterpay was one of them. I remember everyone was getting on the bandwagon with Afterpay. By the time that Afterpay had gone up, again, you can't time the market. The upturn's already happened. By the time you get in there, you've missed that upturn. So in order to make the most of your investments and to get the upturn in all the different sectors is to diversify, remain invested, and don't chase the last big return, right? So let me ask you a question. Have you ever been tempted to buy shares just because their trending is up, or they're in the news, or their next biggest thing, and everyone goes, oh, we've got to get a piece of that? This is herd mentality, an investing habit that is I guess it happened in the 2017 Bitcoin rush. Certain trends that happened and people got on that bandwagon. So many investors who jumped on these bandwagons incurred significant losses. Yeah. Instead of chasing the latest trends, investors should resist the temptation and make a more informed strategic stance. And that is why we come back to risk profiling, diversification, researching, knowing who you are, what you stand for, what are your not negotiables, don't chase the shiny stuff, setting the right financial goals and investing in the right assets in the right way, and having a patient approach and not just buying things because you think you should, because, you know, Bob down the road did it and he's made 20 grand. And he's boasting about this 20 grand, and you've got all this FOMO thinking that, God, I should have done that and I should have done that. There's no such thing as I should have. There's no such thing as chasing the next big win. There is invest now according to your risk profile, according to diversification principles, according to dollar cost averaging principles, according to your financial goals, staying in for the long term, not constantly checking your portfolio, not buying the next best thing, and not continuously adjusting your investment strategy, which is the next thing I'm about to go into. So the third really, really bad habit, I've had clients over the years that have come to me and said, oh yes, I took all my investments out, and this was in super, by the way, and I've put it all to cash because they said that there's going to be a correction. I just cringe. I think, oh my God. So here's what happens when you do that. Let me explain this. Whether it's super or non-super, if you're invested in managed funds, and your super is all in managed funds, by the way, and obviously you've got some shares, property, fixed interest and cash, the minute you sell all of that down, because if you sell down the investments and go straight to cash, all of those investments are going to be sold at the day that the sale goes through, and no one knows whether it's at a high or it's at a low. You take whatever the value is on the day, you sell out. So you crystallize capital gains that may be payable within there as well. So you could trigger capital gains. You could be selling at a low and not selling at a high because you can't choose those things, and you're coming back to cash. So you're crystallizing any losses, potentially taking any profits, and then you're coming back to cash, and then you've got to go back and get invested in the market again. That is the worst possible thing you can do. Chopping and changing your investment strategy is definitely the worst possible thing you can do, because you're constantly selling out and buying in, selling out and buying in. And that is costly from an investment point of view, and it doesn't allow your investment to bed itself down and provide you with the returns that you're looking for over the long term. It's similar to, I have had clients over the years, it's similar to buying and selling properties over and over again. With every property you sell and buy, stamp duty, agents' commissions, at least, I don't know, anywhere between 50 to 70 grand, maybe 100 grand in costs of selling and buying, selling and buying. You do that 3-4 times and you're up to nearly $400,000 in costs of buying and selling properties. And where is the value in that? Has that buying and selling actually resulted in you increasing your portfolio in the investment property market by 400,000? I don't think so. And over the short term, and you've just spent nearly 400,000 in buying and selling costs doing that. It just doesn't make sense. Buying and holding is the position that we want, and sticking to the foundational knowledge of, again, I know I keep repeating myself, but I just want to reiterate, risk profiling, invest according to your risk profile, hold on for the long term, add to your investment for dollar cost averaging, and the ability to maximize the power of compound. Staying within those parameters is the only way forward, and is the best way to create wealth and avoid these mistakes of checking your portfolio daily, running after the next greatest asset, thinking that that's the way to go, and then constantly changing your investment strategy. All of these really, if you think about it, what have they all got in common? The emotional aspect. It's your emotions that are getting in the way that is causing this sort of behavior, and it's playing out in the fear of, oh my God, what if I've got it wrong? Oh my God, what if I haven't bought the next best thing? Oh my God, there's going to be a correction. I'm going to go to cash. Oh my God, I've got to check it every day just to make sure it's all okay. It's all fear driven, and it all really centers around emotion, and we've got to get all over our emotions, and we've got to be able to manage that if we're going to create wealth over the long term. And the best way to do that is to invest, is to stay invested, and to educate yourself on the basic foundational principles of investing, and you can't go wrong. And the longer you stay invested and stay on that pathway, the more comfortable you will become, the more you will learn and understand, and therefore avoid all of these terrible mistakes, particularly these 3. So make sure to subscribe to our podcast on your favourite podcast platform. Thank you for joining me, and I'm looking forward to sharing with you more of my pearls of wisdom over the series of this podcast.